The subject of this video is U.S. floating rate equity preferred stocks. These stocks are far more complicated than the fixed coupon preferred stocks that I discussed in my last video titled, quote, Fixed Coupon Equity Preferred Stocks, in the quote, which I will link in the More section below. And in that video, I discussed the differences between cumulative and non-cumulative preferred stocks and which preferred stocks pay qualified dividends. I will not be repeating that discussion here. More information about these securities can be found at the quantumonline.com website, which has links to the prospectuses, which need to be reviewed prior to any purchase. I cannot go over all the nets of these securities in a video. The site is free to use but does require registration. One variety of U.S. floating rate preferred stocks is called fixed to floating rate preferred stocks. They are similar to the Canadian reset equity preferred stocks traded on the Toronto Stock Exchange and priced in Canadian dollars that I've discussed in a previous video, which I will link in the More section below. The Canadian resets have easily been the most profitable category among preferred stocks for me. I own a lot now and have realized over $19,000 in realized gains expressed in Canadian dollars trading them. Snapshots are in my blog. They were in the past frequently mispriced in my opinion, which is why I used some Canadian dollars held in my Interactive Brokers account to buy them. But they are not, in my opinion, mispriced now, so I'm in a liquidation mode rather than buying more, which has led to a surge in idle Canadian dollars in that account, which I need to figure out what to do with. Interactive Brokers does pay a dividend on my CADs. The U.S. fixed to floating rate preferred stocks will pay a fixed coupon for several years and then switch to a certain date provided in the prospectus to some kind of floating rate. The issuer has the option to call at par value when that transition is made from the fixed rate coupon. So whatever benefit that you thought would happen with the floating rate may be taken away from you before receiving one coupon payment at the floating rate. The fixed to floating rate preferred stocks are not issued by companies for your benefit. It is for their benefit. The fixed coupon will generally be lower than what the company could offer or sell if it just sold a fixed coupon preferred stock with no floating rate feature. So it is able to finance at a lower rate, and if short-term rates become too high when the floating rate period starts, they'll just call it and take it away from you. The issuer, as I said, has the option to call at par value when the transition is made. So at that time, if they don't want to pay it, you'll never get the benefit of the floating rate. Most of the floating rates are at spreads to short-term rates, assuming no call when the transition is made to a floating rate. The coupon is based on a spread to a short-term rate and will move up and down, usually on a quarterly basis, in tandem with the short-term rate movements. Most of the prospectuses for fixed to floating rate preferred stocks used the now defunct 3-month LIBOR rate as the short-term rate. That rate has been discontinued because it was subject to price fixing among financial institutions, and they had to stop that after being pursued by governments. Most, and there's one exception that I do not own and cannot remember the name of now, which will use the alternate rate rather than LIBOR, which is called the 3-month SOFR as a substitute for the 3-month LIBOR. SOFR stands for Secured Overnight Financing Rate, and the whatever that number is now you can find online. To equalize the SOFR with the now defunct LIBOR rate, the firms using that short-term rate now are required to add what is called a tenor spread to the 3-month SOFR, which is 0.26161%. And that is required to be used in order to equalize SOFR with what used to be the LIBOR rate. Generally speaking, and the prospectuses need to be consulted for variations, the coupon will reset every 3 months for as long as the security is not called. When the spread is based on the 3-month SOFR rate, which is what most of them use, as I just said, with one exception that I cannot recall at the moment. And I thought that company that declined to use the 3-month SOFR rate as the alternate rate misinterpreted its own prospectus, in my opinion. And generally speaking, the issuer reserves the right to call on each reset date during the floating rate period, which is what they will do when it is in their interest to do so, meaning that the short-term rates are just too high for them to pay, so they want to get out of it. If rates are low, particularly when they would result in a lower coupon during the floating rate period than what was paid during the fixed rate period, the issuer will allow you to keep the preferred stock. There are a few exceptions to using the 3-month rate as the base rate. I own one preferred stock that was sort of out of consideration for my memory bank had forgotten that I even owned it. It has the symbol SNVPRE that reset for 5 years at a 4.127% spread to the 5-year Treasury note as the base rate. And that 5-year note yield was determined around last June or July, I forget. That one is now selling at a premium to par value. The fixed rate was at 5.875%, which resulted in a per share quarterly dividend around 0.367, I wrote down. The new quarterly payment is 0.52481. I was shocked that the company did not call it par value on the reset date, rather than allow this preferred stock to reset. Now the rate is set for 5 years and cannot be called until the next reset date in 2029. This is the same kind of result that happens in the 5-year Canadian resets that I own, except the reset is based on a spread to the 5-year Canadian bond, and once the coupon resets, it cannot be called for 5 years. The issuer for SNVPRE is a bank holding company, so the dividend is qualified and non-cumulative. And there is a risk of a zero stock price when and if the FDI ceases the operating bank. That will invariably occur for bank holding company preferred stocks. The debt at the holding company level will far exceed whatever the value of whatever assets are left after the operating bank is seized by the FDIC. Another type of U.S. floating rate security, which is just far too complicated for any video discussion, are that I classify as something called synthetic floaters that trade on the stock exchange. I discuss them in my blog, but do not currently own any. They're not suitable for most individual investors, in my opinion. Another type of U.S. floating rate security, which I have owned in the past but have eliminated all my positions, can be generally described as paying the greater of a fixed rate coupon or a floating rate one. One that I have owned in the past, and this is just an example among many that are available, is issued by MetLife and traded under the symbol METPRA. It pays the greater of 4% or 1% above the 3-month LIBOR rate, now the SOFR plus the tenor spread. That coupon is paid on a $25 par value. During the period of my ownership, the coupon was the minimum 4%, since that was more than what would have been paid using the floating rate. When the Fed started to increase the federal funds rate, the SOFR rate started to rise in tandem, and the METPRA started to use the floating rate as the coupon rate when that provided a higher coupon than the 4% minimum. This METPRA was a good security for me. I realized significant gains trading it. The peak so far is a quarterly rate of 0.43028 that was paid in the 2024 second quarter. But since the Fed started to cut the federal funds rate in September, this rate has trended down and will continue to do so for as long as the Fed cuts the federal funds rate. And it's no telling how many cuts there will be, or if there will be another cut. You can't say for certain. But at some point in a rate cutting process, the floating rate will again fall below the 4% minimum, and the company would resort to the 4% minimum coupon payment under that scenario.